Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, April 10th, and today is Good Friday. As you all know, the market is closed today for the Easter holiday. Now, before we go on, I would like to wish you and your loved ones a very safe, healthy, and happy Easter. Well, the Labor Department reported today that U.S. consumer prices fell by the most in more than 5 years in March, and further decreases are likely as the coronavirus outbreak suppresses demand for goods and services. The Consumer Price Index dropped 0.4% last month, the biggest drop since January 15, and it did follow a 0.1% gain in February. So February was good, March not so much, but that's to be expected. And now let's go on and look at 3 charts that could give us some insight into the week to come. Now, first of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our S&P 500 benchmark index. Now, we know that the SPY made an all-time closing high back here on February 19th at $338.34. Then it fell dramatically down to the lows here at $218, which is about $21.80 on the S&P 500 itself. Now, the SPY since then has rallied in the last 3 weeks of trading. We'll take it. That's a good thing. We'll take it. So it's clawed its way back into correction territory. We're no longer in bear market territory like we were. We're in correction territory, and now it is currently 18% off its highs, which means we're still in correction territory. If we were in 20% or below, we were in bear market territory. So we're back at least. We're back up to actually up 28% from these lows, and now, as you can see, the SPY is trading above its 20-day moving average, the red line once again. It closed Thursday, yesterday, at $278.20, about $27.82 on the S&P 500 itself. So nearby support here, if we want to find some support, we can see it right here, very, very nearby support at $276. Then we can go down and look at this is support, was resistance level. That stayed in place for quite a while at 263, and then we have another, this is all potential of course, support level at 244. Now, this rally that we've seen, it's been wonderful, it's been lots of fun. We had a lot of short covering in this rally, and I talked to you about this a couple of weeks ago. Whenever you see an asset or an index like this, when the SPY came down to these lows of 218, and closed down here somewhere around 220 on that day. The next day, it gapped to the upside dramatically. Whenever stocks or even indexes hit new dramatic lows and then gap up on a morning, certainly on high volume here, that a lot of that has to do with short covering. It means the people, the short sellers who were short, had to buy to cover their position because they're getting squeezed. It's called a short squeeze. They're miserable, in other words, and they want to cover their position. So you've got buyers buying, you've got short sellers covering or buying, which is how they cover or exit their trades. So then we had a really nice pop here. Now, certainly that wasn't all short sellers covering. Certainly there was buyers in here. We had a little pullback right here. And in this area here, too, we've got a lot of FOMO, which is fine, fear of missing out. That's fine. Perhaps some buyers in here, certainly some smart money got in, some of the institutions, they can take bigger risks than a lot of us can. So we've had this absolutely delightful rally, but we want to be very careful here. Again, it closed yesterday, Thursday, at $278.20. We have a possible doji here, meaning it opened and closed at about the same price. Very, very narrow range day. Of course, the market did close early as well on Thursday at 2 p.m. So we have this move here. Do I think we're going to go straight up and continue higher? My crystal ball's in the shop, but with what we have going on, even without my crystal ball, I imagine that sometime in the next week or two, we could get another pullback or retracement here, hopefully not all the way back to the lows. We have had, if you've been watching CNBC or the other financial networks, you've been seeing constant references to what shape this market will recover in. Now, so far, we have an almost V-shaped recovery here. Is it sustainable? There's a lot going on. We've got, of course, another OPEC meeting. We have first quarter earnings will start to come out here this coming week with the financials. And what will be really interesting to see with especially the big momentum companies is what is their guidance for the second quarter going to be. It's like we get that things have happened now to damage earnings, but what will the guidance be? How can it be overcome in the second quarter? So we have that going on. I will be interested in seeing what is reported. So any buying I've done in here has been really, really small positions. I don't know if the environment we're in warrants a huge V-shaped, gee, nothing really happened recovery yet. I'm still watching. I think we have a ways to go here yet. So please you might want to keep trailing stops in. As you know, the economy at the moment anyway has gone to a halt. And if you've already started the bottom fish, again, keep your protective stops in case we get any more negative news. Please know if that happens, the short-term traders, and maybe you're one of them, I am, will take profits. So please remain watchful. Please remain a little bit conservative here till we get maybe through April and more into May. Yes, you can make money, but it's always wise to keep your stops in, especially in a market like this one. Okay, so our next chart today will be a chart of the Invesco QQQ, simple QQQ. As you all know, this is the ETF that represents the NASDAQ 100, a very important index in our market and holding the top large momentum stocks. Now, like the SPY, the QQQ made its all-time high here in February, actually February 19th at $236.98. We can just call that 237 and make it even. And it's come down since then, all the way down to the 160 area here, 164.93 to be exact, and then rallied back up. So we're 15% off these all-time highs. The QQQ is, of course, that's just in correction territory, not bear market territory. Had a big rally here, big rebound, just like the S&P. On both indexes, it's positive to note that both of them made higher lows here. At least for now, we have a higher low, and that's always a positive move. After all, uptrends are designated by higher lows and higher highs. So we have a higher low on both the SPY and the QQQ. That's a good thing. Also, the QQQ did manage to close, unlike the SPY, it managed to close above its 200-day moving average, which is coming in here now at $199.88. The QQQ closed yesterday, Thursday, at $200.86. So it just squeaked right above this and held on for dear life. So far, so good. We have nearby support down here at about 194 potential support. We have more potential support here down at about 181, 182, 183, right in there. So we're going to watch, obviously, the QQQ. Again, we're going into first quarter earnings season. It's going to be very interesting. No reason why every company had to lose money. And probably not, but still in all, it's going to be an interesting time period here. And I'm going to use, again, about 169 here as support, and we can draw a trend line up here so we can see that there's plenty of support here in these zones. But again, we've got earnings coming up. We're still in kind of a crazy period with this COVID-19 coronavirus. that we're going through. We could see resistance here in the falling 50-day moving average coming in at about $206. So if you start to, again, kind of nibble on trades, do a little bottom fishing. If you haven't done so already, please be very cautious here. We've had quite a big run up, and I worry a little that we maybe have gotten too far over our skis here and that the market may need to come down a little bit. Please again remember, lost opportunities are far less expensive than lost money. So if you're starting to nibble, be careful, but I actually would give it a couple of days. All right, so for our next chart here, we're going to look at one we haven't looked at before. This is the Global X Future Analytics ETF, symbol AIQ. This is an international ETF with 84 international holdings. But the top holdings are Amazon, Netflix, NVIDIA, Tencent, which of course is Chinese, Microsoft, and Oracle. Now, we can see that the all-time high here on the AIQ was February 19th at $19.97. It fell to make a March low here at $12.75. It closed yesterday, Thursday, at $16.29. So right at the moment, it's about 18% off of its highs in correction territory. I think AIQ is definitely going to be part of our future. This ETF has done a good job here. I'm going to keep my eye on it. Now, I'm going to tell you right now, I would prefer if the AIQ would pull back here a little bit to give us, or me at least, a little better entry on here. It's above its 20-day moving average. Its 200-day moving average is coming in here at 1688, and its 50-day moving average is coming down overhead at 1705. That could cause some resistance here. So I'd really rather it get a running start than where it is right now, but I think it definitely has a future. So I'm going to wait and watch here, see if the AIQ can pull back a little bit, or at least my question to myself is, can the AIQ in this coming week stay above $15? That's the level I'm giving it. So a little pullback and then a move up would be good with me. But at least, is it going to stay above $15? If it can remain above that line, I may buy a very small position. Again, we're going into earnings season, with an initial stop at $14.25. Now, as I've said before, if the market starts to roll over hard on more negative news, I may exit the trade early, and I will, especially this one, because this does have a lot of momentum stocks in it, and they tend to fall faster than value stocks. So if the market rolls over hard, I may exit before it reaches my stop. I'm again watching it to see if it can stay above the 15 level. On the positive side, if the AIQ, if and when it can push above its 200-day and 50-day moving average, and that would be above probably $17 by the time it gets up here. If it can do that, I may add more shares to my position. And hey, this may be 1 or 2 or 3 weeks from now. It's just hard to gauge in this market. If that happens, I may add more shares to my position, and I will definitely by then have turned my stop into a trailing stop. So you may want to keep an eye on the AIQ in the coming week. And now, please know that I have temporarily suspended my usual list of next week's economic reports to briefly touch on the topic below. If you want to see a calendar of the economic reports, go to toniturner.com, click on Education, and then click on Economic Reports. I thought we'd talk about something this week that may be apropos to the season we're in. And I'm going to call this the question of the week. Do I devote time to trading regrets? And if so, how does that limit my future decisions? So please know you all, that the feelings of pain and regret that we experience from a loss are much more intense than the joy that we receive from the same amount of gains. So if you lose $500 on a trade, you have to get out at your protective stop, and that's not a bad thing. But if you lose $500, the pain you experience is going to be much more intense than if you earn $500. If you profit $500, it won't be as intense a feeling as if you lost it. And in this market especially, where the market tends to move up all day and then before the bell closes it crashes and falls, or it starts out down and then all of a sudden it's up. It's easy to get whipsawed in this market. So what I'm thinking here is that it may be wise to scale into positions, and I talk about that. Maybe instead of buying a whole position that you want to get into, maybe you buy a third of what you intend to be in the end, or a half of what you intend to be in. If you were going to buy 500 shares, maybe you buy 200 shares, or maybe you buy 300 shares, and maybe you don't buy the whole amount. Research in behavioral finance shows that traders who jump into an entire position at once and then take a loss are much more likely to blame themselves in a big way and experience much more regret than if they had scaled into that position. And then when you have this negative outlook and you make your next decision for yet another trade, it could definitely be the wrong position. So if you scale in and use a trailing protective stop, should you experience a loss, it should be a lot less, and so should your feelings of regret. Now, just as a reminder, I will tell you again that we are offering my How to Bottom Fish Like a Pro online training at a 20% discount. We're going to do that for just a little bit longer. So if you'd like to check it out, it may be a good time to learn how to bottom fish effectively. So please, you all have a wonderful, happy Easter. Stay safe and healthy. Until next week, keep green on your screen. This is Toni Turner, and this is The Market Now.